Thanks a lot, Ryan. It's a pleasure to be on stage with such successful VCs. And I'll start off today is kind of this rudimentary question. Is it the right time to invest outside of Silicon Valley? All of you are based here in Silicon Valley, but you regularly get on planes, spend a fair amount of your life on planes, flying to other countries, meeting founders, and making investments there when you're based here in Silicon Valley, which is no doubt, if not the, at least one of the centers of tech of the world. So tell us, why do you do it? Why do you get on planes to go elsewhere when you could be making investments here?
Okay, so for those of you who don't know, I'm Glenn Solomon. I'm with a firm called GGV Capital. We've been in business 17 years, and from day one, we've been focused on two geographies, primarily China and the US. And so the short answer for why I get on planes frequently is that I'm often going to China. I think we're going to get into the relative virtues and challenges associated with global VC, but for sure, something I'll put out there up front is I think the venture capital business is, despite the fact that the world is getting flatter, particularly from a technology standpoint, and we can all benefit from that, the business of growing startups is a local business. And so if you're not local, both to select the right entrepreneurs with whom to work and then be very close to them, because it's a hand-to-hand combat when you're trying to build a company from the earliest stages. If you're not close, then challenges that you can otherwise address quickly sometimes can spin out of control. So a big reason for why I travel and my partners at GGV are all traveling back and forth is that we really want to be close to our companies. And so many of our companies now are trying to grow globally, which we truly believe expands their opportunity, ultimately expanding the opportunity for us to earn a return. So those are the primary drivers for the travel for us.
Right on. Anyone else? Charles?
Just Charles Moldow, Foundation Capital. Just some context. We decided in 2006 or 7 that we were going to expand both into India and China. And we went about hiring people in those markets, getting up to speed in those markets. We raised capital, and then in 2008, when the market changed on us, we decided that spreading ourselves that thin in a tough market wasn't the right answer, and we pulled back. And in hindsight, watching some of the partners I know who travel on airplanes and get on conference calls at 11 p.m. to deal with time zone changes, I think it was somewhat the right answer, at least for Foundation Capital. The compromise, I would say, that we've come to in our own partnership is that there are certain areas where we have deep vertical domain experience, maybe like fintech, for example, and where we can export our expertise into companies that we understand well in markets where we can get our heads around quickly. It doesn't feel like such a stretch. Getting into markets where we don't have deep vertical expertise would feel a bit out of the reach for us. So I'd say our compromise has been, we are doing it, but we're doing it only in areas where we really have unique insight as a result of our existing portfolio.
It's a great perspective.
Yeah, we started in 2010 as DST, and we have been global from day one. So our thesis was to invest in late-stage consumer internet companies globally. And that's the thesis with which we started back in 2010. And about 60% of our capital is invested outside the US. And the way I think about why we spend time outside US is two reasons. One is very quantitative and one is a little bit more qualitative. The quantitative answer is when we look at consumer internet as a sector, it's a sector which has a market cap of about $3.5 trillion globally. And about 40% of this market cap comes from outside US. So in absolute dollars, this is like $1.5 trillion of market cap. And it's a big enough number which to us justifies our spending time outside US. So that's kind of the quantitative part of it. The qualitative part of it is particularly over the last 3 to 5 years, we saw increasing innovation coming from outside US. So for example, one of our portfolio companies, Meituan, is doing like food delivery in China. And this is a sector which is like about 25 to 30 times larger in China than in US. So being in China enables us to see this innovation both on the business model side as well as overall on the company side a little bit earlier. Ofo, which is like another portfolio company of ours, is doing dockless bike sharing in China. It's a business model which was essentially invented in China. So things like this give us confidence that spending time outside US also helps us evaluate companies in US.
Oh, okay. Yeah, that's a good point. We're going to get a little bit more to that last part in a little while. Many VCs here in Silicon Valley don't quite think the same as you, and they say, well, I can add the most value here in Silicon Valley to startups here in Silicon Valley, so I'm going to avoid international deals and in many cases ignore them. And do you what do you say to them? Do you believe that I mean that's still a valid strategy today, or should VCs in any case at least be open to the opportunities that are from outside Silicon Valley or outside the U.S.? Glenn, do you want to start us off?
Sure. Point I alluded to earlier that the world's getting flatter certainly from a technology standpoint, and as it relates to China and the U.S., which are the geographies I have the most familiarity with on a global basis, it's just unquestionable that you can build a bigger business and a more valuable business if you can figure out how to go global. And so, while starting your company is a grassroots local effort, those entrepreneurs that figure out quickly how to expand the size of their market seem to be the ones that are most attractive, at least to us, and have created the most value over time. And if you look at like the current, one way to look at value, look at current unicorns out there, companies that are valued at over $1 billion that are private today, that have received venture capital backing. Last numbers I saw were that 80% of all those companies, that the U.S. has a great share of those companies, something like 50% of all unicorns were born in the U.S., but 30% were born in China. So 80% covered by those two geographies, and I think the number is 90% of the value in unicorns sits in those two countries, and there China's actually larger than the U.S., the last numbers I saw. So for us, it would be crazy not to consider investing in both and encouraging our companies, where appropriate, to consider accessing both markets where that makes sense.
Right on. Okay. Saurabh, would you like to add something to that?
Sure. So I think it's a very valid kind of like point of view to say that as a VC, one can be like focused on a single geography, US, for example, and they can add like the most value by focusing their energies on the single geography. Their relationship network can be deeper and wider, and they can like help the portfolio companies more. So I think it's a very valid strategy, and 60% of $3.5 trillion is still $2 trillion. So it's still a big opportunity that you can go after if you're focused only on US. The way I think about it is, as global investors, can we add complementary value to what some of the local investors would be adding? And I think historically we have been adding complementary value in a few ways. First is by connecting our portfolio companies with their peers in other geographies who might be doing exactly the same business or very similar businesses, and maybe at a different stage of evolution of the company. So they can kind of learn from each other. And I would argue that it's, at least in certain cases, it's more valuable to learn from other founders and other management teams than from me, for example. So this is one way in which we see ourselves adding complementary value. Second is what Glenn said, which is when companies think about expanding outside their domestic markets, At that point, having a global presence and a global relationship network can be very complementary to the local relationship network of some of the other investors. So for example, when our company Xiaomi wanted to expand in India, we helped them with Flipkart, which is also a portfolio company. Or when Farfetch from Europe wanted to expand in China, we helped them structure a transaction with JD. So things like that, basically. And lastly, we see many of the large technology companies outside US also becoming very active acquirers, very active investors. So as global investors with this global network, we can help with some of those dialogues as well.
What do you all think are some of the biggest challenges to running a kind of cross-border fund versus a single geo fund? What do you find yourselves whining about at the bar with your VC buddies that they completely don't connect with you on because they're doing a single geo?
Yeah, Glenn is not at the bar because he's on conference calls till late at night. So
Exactly.
if he were
So
at the
they're not
bar, he
even
might
there.
be bitching to me, but
Not
I
even
never see
there,
him at
right?
the bar. Yeah.
Well, I guess the answer is travel. Might be the biggest challenge, but for us, the other big challenge is team. Because the way we are structured is a single global partnership and a single global IC. With partners spread across 4 different geographies and time difference of 16 hours, which makes it slightly challenging to even get together as a partnership. So the way we do it is instead of Monday morning partner meetings, we do Monday video conference calls. And unfortunately, one of the 5 partners always has to be up between midnight and 3 a.m. So that, I guess, is the challenge.
Mm-hmm.
I'll take a, so Saurabh's firm has people on probably more continents than we do most days. But like Saurabh, we have that challenge as well where, Silicon Valley, we have offices in Beijing and Shanghai, and so we're 15 or 16 hours apart, depending on where we are with daylight savings here in the U.S. And so we've adopted a similar convention where our partner meetings start at 5 o'clock U.S. time on Monday evenings. We have good video conferencing capability, and we'll go as long as we need to. This past week, there weren't too many other cars at 3000 Sand Hill at 9:45 p.m. when I left the and I definitely didn't go to the bar from there, Charles. But so there's just the simple things like when do you do your partner meetings are a great question to ask firms that purport to be global. I remember a funny anecdote talking to a Sand Hill, very strong, great brand name Sand Hill Road firm who shall go nameless, and I asked a partner there because he was saying, oh, well, we're in China too, and we're also in other regions. And I said, when do you guys do your partner meetings? And he looked at me like, what do you mean? We do them at 9 a.m. Monday mornings, on Silicon Valley time. And I said, but do you know what time that is for the guys over in China? And he looked at me and said, no, I don't. Well,
1 a.m.
1 a.m. So it can be tough if you don't really buy into that cross-border, we're a global firm culture. We don't have a headquarters at GGV, we just have offices. And like Charles said, we organize around sector, not around geography. And so it takes that commitment. It means a lot of miles on the road.
Aside from, obviously the challenges around travel and time, what about the added risks that are involved in dealing with government risks in multiple countries, or exit risks, risk of being able to get your proceeds or funds out of the country at exit time? All of these risks. How do you evaluate these versus a single geo fund?
I'll start with that just because we were just looking at a company based in Kenya the other day, and the exchange rate risk was a material risk that we couldn't figure out how to resolve. And because we're not dealing globally every day like these guys, it's an expertise that we don't necessarily have. And so as you think about how that company gets funded and where it generates its revenue from, it becomes a material issue and a risk factor that we can't otherwise account for. And then when you add government risk and geopolitical risk, it makes it just that much harder to get your head around doing a project somewhere else. I mean, sure, it's like maybe UK, Germany, fine, but as you start getting into secondary markets and emerging markets, it becomes really hard.
For, I guess, DST, you guys often do deals in many different geographies. Are there certain places of course there are, certain places you absolutely wouldn't do a deal, but are there, if they're outside of the scope of, let's say, these 8 or 10 countries that you've done deals in, do you hesitate at that point, even if you believe it's an exceptional company?
Well, I think if we don't have a reasonable level of confidence that we understand the market well, and we are able to have a view on the market over the next 10 to 20 years, then we would definitely be hesitating. But if we are able to get comfortable that it's a market which we understand reasonably well, and we are able to take like a 10-20 year view on the market, and as you said, if it's an exceptionally good opportunity as a global fund, I think we would look at the opportunity very seriously. So we have invested in US, obviously we have invested in China, India, Indonesia, Brazil, Germany, UK. We have been investing in a few countries.
Let's talk about how your LPs view your fund, also versus kind of single geo funds. I'm sure if they're active on Sandhill, many of the funds they're investing in are mostly Silicon Valley focused or US based funds or US focused funds. How might LPs view you versus them? What questions do they ask you? What are their concerns with a cross border fund, a global fund versus purely local funds? Glenn?
Sure. So I think that's a great question, and it's evolved. Certainly for GGV, it's evolved over time, and I suspect we're not the only ones. When GGV got going 17 years ago, I joined the firm 12 years ago, so I missed the raising of Fund 1. But when I spoke to LPs before I joined, in not so many words, I heard several of the LPs, and the LPs I was talking to are very traditionally U.S.-based institutions that invest in VC, so a couple of college endowments, some state and local pension funds, etc. What I heard basically was, hey, GGV is interesting. In so many words, GGV is interesting because we'd like to invest in China, but there isn't really an opportunity for us to invest in China in a way we feel comfortable right now. And we know where you guys, we know where you are on Sand Hill Road. So like, and you seem to all be one team. So we know where to go. If we need to choke somebody's throat, we know where to go do that. But at the same time, we kind of feel like this is a safe way to get some exposure to China. That's basically what I heard. If you asked our LPs today why they invest in GGV, you would not hear that from a single one of them. What they have the opportunity now, and I think this is true of geographies beyond China, to invest in terrific local funds who are who are very investable for even the longest term and highest quality institutions here in the U.S. And who have produced excellent returns and have great teams and are interesting to and definitely attracting lots of capital. And so the play that GGV tries to make, and I think it's working well for us right now, is again along this theme that the world's getting flatter, and so many of the companies we're investing in are taking advantage of the fact that we're in both markets and can really help companies with across the Pacific in one way or another to access capital, to access an end market, to access supply, et cetera, people exchange. And Saurabh mentioned earlier that there's a lot of ideas that you can get or understanding from one market that applies to the other. We definitely see that in spades, and so that's why LPs are looking at us. But they have concerns as well as they have concerns with any VC firm, and it's a question of getting to know people and producing results over time and building that relationship.
Yeah. Anything else to add to that, Mr. Robert Charles?
Yeah, I think just like our portfolio companies end up self-selecting for VCs who kind of like believe in their strategy and believe in the team. I think in the same way, we end up self-selecting for LPs who believe in our strategy and believe in our team. And there would be certain institutions who would have a bias towards investing most of their assets in US for a variety of reasons. And then there would be certain institutions who would see actually a lower risk from investing in a global fund because it's diversified across multiple geographies, and typically diversification leads to lower risk. So different institutions and different LPs have different priorities, and I think we end up self-selecting for people who believe in our strategy.
Okay. And Charles, I'll direct this question to you. You do have a number of international portfolio companies, and how do you provide really exceptional product feedback, business model feedback to companies when you may not purely thoroughly understand the local market they may be in? If you're investing in a German company, or as an example, how do you provide great feedback?
I think it's a particular challenge because we don't often think about that when we invest in these companies. We think we like the market, we understand maybe, broadly speaking, the demand for that product. We can understand how to evaluate talent without understanding culture maybe. But when it comes to specific product feedback, it can be really difficult. The other day I had one of my German companies has a concern as to whether they're disclosing adequately a charge that they're making on their clients. And so they sent over some screenshots to show exactly how they're disclosing and wording the language. And they sent me screenshots in German. I don't speak German. I'm staring at it like I have no idea how to provide you with feedback here because I can't appreciate the nuance with which how you've worded this. Which for us just brings up maybe a ancillary point, which is when we and when all firms I think invest in markets outside our own core market, there's a question of how much value we can really add and at what points can we add value. And one of the specific things I think is very hard for us to add value on is the people dimension. If you have a problem with the CEO here in Silicon Valley, I have enough people in my network that I could probably bring somebody to bear to help that person or to help that company and help me navigate the situation. If that happens in India or in Germany or in the UK and France, wherever we are, I don't have that kind of network to pull on. So for us, at least, it's very important that we partner with VCs who are local to that market who have great experience. And there's certainly a number of VCs you can point to in all these markets. Or you build your own talent, like let's say GGV has across Shanghai and Beijing. But without that ability to influence at the local level, whether yourself or your partner, I think it's really dangerous to be putting money to work internationally.
Okay, great feedback. We mentioned a few times valuations, and obviously valuations really differ greatly across regions, especially when you compare China with the U.S. versus Israel. How do you deal with that within your firm when you may be paying very different prices for similar companies in different regions? Is there standards that you create, or is it all just a one-off situation? How do you deal with various differences in valuations? Especially let's start with you, Glenn, since I know you're in China, and I think many believe that China valuations are quite higher than even here in Silicon Valley. So tell me about that.
Okay. So valuation is one input of many that go into whether or not any VC firm is going to make an investment. But it's certainly valuation has a big impact, obviously, on ultimate return for any deal, and so valuation on the way in and valuation on the way out. And so it's definitely something we think about. The way we operate at GGV, we don't have a tops-down model of we're going to invest X% of our capital in this geography and Y% in this geography. We do everything bottoms up and are looking at deals cross sector teams as opposed to geographies. And so from time to time, we do see discrepancies in how our two main markets, China and the U.S., value companies. And when that happens, we will start to invest more aggressively in that market where valuations look more attractive, just because the bubbling up of deals from that market all of a sudden start to look really interesting. And I can think of a few times over the past decade plus where that's happened. But I would say that more often than not these days, one of the consequences of the world getting flatter, particularly across U.S. and China, is that there's a high degree of correlation between valuations in these two markets. At least there has been over the last several years. So we had a brief period here in the U.S. in early 16, as I recall, it might have been late 15, early 16, where markets swooned for a little while and valuations came down, and we made several investments right in that time in the U.S. that have all gone on to up rounds since, significant up rounds. So I feel pretty good that we made the right decision then. And if that happens again in China, or the U.S., we'll probably end up doing the same thing. But you can't plan for those, and so we just kind of continue with our boring bottoms-up analysis and see what happens.
Saurabh, anything to add on valuations?
Oh, I would agree with Glenn. I think it's very much bottoms up and opportunity specific rather than any single perspective. But again, as Glenn was saying, the one benefit of being global investors is you can invest in geography where you find the most attractive risk-reward scenario. So, you're not necessarily wedded to a particular geography, and if you don't invest in that geography for the next 2 years, it doesn't mean that you have to go on a holiday.
A couple last questions before we wrap it up here. There's an increasing amount of capital available to late-stage startups, and this is giving the ability for many startups to pretty much stay private much more longer than traditionally they would have, and traditionally having IPO much more sooner. What are the impacts of this trend for each of you individually? And then how do you think, is this a positive trend that you see? And what's going to happen if we're extending IPOs, or will there be more M&A? Should we expect more M&A? So all that to say is, what are the impacts of so much capital being available for private startups at late stages, allowing them to push off IPOs? I'll start with DST, since you are quite
we are providing
among the most
capital.
late stages.
So the way I think about it is, as long as the founders and the board have a strong view on business advantages of remaining private, I don't see a concern with them staying private. If the business will benefit in a particular way by staying private for longer, I think they should stay private longer. It should not be a strategy to wait for valuation to reach like the last round's price, or it should not, essentially it should not be like an artificial reason because of which the company is trying to stay private. There should be a business case for staying private longer.
Okay. Charles?
Yeah, I see some benefits of it for sure, but I think it's more detrimental than it is beneficial. Partly the LP community, our investors, our customers, are really worried about the trend because they need liquidity themselves. Foundations and endowments, they take the returns that we deliver to them and they need to go fund whatever programs they're funding. And when we see the duration of the turnaround of that capital from fund to fund elongate, it means they're not able to continually invest in our funds and also account for the things they need to go fund themselves. So I think it's particularly challenging for the LP community, and they're putting pressure back into the VC community to do something about it. Not that there's a lot necessarily we can do about it. But the other thing that is troubling is just there's a certain rigor that going public puts companies through, whether it's Sarbanes-Oxley or just the rhythms that you need to get into to be a public company. And I get that private founders are saying, hey, I need to run my company for the long term, and the markets are short term in focus, and so it'll ruin my ability to continually invest in my product and build a company long term. But at the same time, the market has to figure out a way to appreciate and value that, because we're losing out on the best of all worlds. We're losing out on the ability for the scrutiny that occurs when you go public to improve the company's internal rigor and processes. And we're losing on the ability for the markets to get access to these companies because the markets have been too short-term focused. So it's problems on both sides that are creating this dynamic, and it's really unfortunate, and the LP community is suffering as a result. I don't think it's going to change anytime soon, particularly with the Vision Fund. So the problem is compounding at this point, not ameliorating.
Okay. All right. You have the last word.
I'll echo Charles's comments here. I think companies, there are many virtues to actually going public and being public for companies, and the long term is really a sequence of short terms. And so I think there's rarely good argument to stay private past a certain shelf date for companies. And I advise companies we're involved with to consider going public, because I think it just promotes good hygiene and good behavior. But at the end of the day, this sort of issue of what I've heard referred to as kind of a dry bubble. I don't know if I'd call it a bubble, but returns in our industry, in our asset class, certainly amongst our firms, has been good. But getting liquidity to LPs has been harder, been more difficult. And I think if you look across the industry, we can't control M&A, and there's lots of private capital, and so we can push companies to think about being public, but they have options. And so one other trend I've been seeing a lot of these days is sort of more limited secondary selling going on amongst VCs. So VCs are in their best companies where there's a lot of demand for others to get in. There are sales going on, so people are getting at least partial liquidity in some of their companies, and I think we'll probably see that continue to develop. It's a little bit of a cottage industry, but I expect we'll see that as a third leg of the stool, as the way VCs get liquid over time.
Great, great last words. Please give our panel a hand. Thank you so much all for being with us.